The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
As the economic backdrop becomes clearer, market conditions become a little bit less certain. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Stocks faltering a bit here while bonds have halted their decline, at least for the most part. The S&P 500 down for a second day, although has pared a lot of its losses. This marks the first back-to-back drop in 6 weeks. Now, the 10-year yield stabilizing. It earlier reached about 4.21%. That's a three-month high, I should say. And yesterday, of course, the bond yield spiked about 11 basis points. NYMEX crude getting to as high as 72.50 on elevated concerns about Israel and Iran and the conflict there. Those same Middle East concerns, of course, putting a bid under gold, which is at yet another record high.
At a record high there on gold, not necessarily on stocks. And a big focus today is going to be on the intersection of all that on global economic conditions as the global stock market rally remains on pause for a second straight day. Rising oil prices, slower economic growth, and bigger fiscal deficits, all compounding concerns. Tobias Adrian, director of the IMF's Capital Markets Department, telling Bloomberg he's worried investor optimism and extended valuations are just too high amid a geopolitical backdrop that could give rise to further exogenous shocks. Now, to be sure, Adrian's comments contrast with the IMF's overall view of global growth, an outlook we're going to dive deeper into in just a second with their chief economist, a conversation on why the IMF is lowering its GDP growth forecast, but still predicting a global economy on track for that greasy soft landing. And the contrast and disagreement out there maybe is not so much of a contrast or disagreement. JP Morgan's Asset and Wealth Management divisions yesterday released a long-term capital markets outlook that included growth rates in real GDP next year that are below the IMF's forecast. But their report, while expressing a tinge of worry, also expressing a sense of optimism as the good may be enough to offset the bad.
So the fundamentals, we call it healthier fundamentals. The fundamentals, whether it's macro, as David just pointed out, or on the corporate side, right? We're seeing stronger earnings per share growth. When you think about earnings power, you're seeing margin improvements. Like, this is an opportunity. That tech adoption that David was talking about, that's not only going to help in terms of revenue growth, but also importantly, improve margins.
And that was Monica Issar over at JP Morgan Wealth. We spoke with her and David Kelly yesterday, and I think all eyes right now are really on 2025 and beyond.
Yeah, they're looking at a 10-year, 15-year window. For now, the IMF is warning investors to brace for uncertain times due to a wide range of risks from wars to trade protectionism. Now, the International Monetary Fund no longer anticipates a modest pickup in global growth. It's trimmed its 2025 forecast to 3.2%, unchanged from this year. That's even as it sees inflation slowing to 4.3% from this year's 5.8%. Advanced economies like the U.S. and Western Europe, these are the blue bars here, will maintain their 1.8% growth rate, while the developing world, here are the yellow bars, will likely expand at a 4.2% pace. Romaine?
All right, let's kick things off here with one of the folks behind that report. Pierre-Olivier Gourinchas is the chief economist with the International Monetary Fund, and he joins us right now to kick us off to the close. Those growth targets, as we know, Pierre, just coming down ever so slightly. I do want to focus in a little bit, though, on the potential for stability and whether you see a more consistent growth pattern longer term for the global economy.
Well, what we're saying, Roman, is there's a lot of resilience in the global economy, and it's a lot of resilience despite the fact that inflation has been coming down, despite the fact that central banks have tightened interest rates tremendously over the last 2 years. So that's kind of the good news. Inflation is now close to target. The battle against inflation is almost won. There are maybe some residual risks out there in terms of inflation path, but, really this is good news. Economy being resilient, yes, but we see the risks of adding up, and we see them to the downside. And among those risks, we see geopolitical risks, the Middle East, oil prices, commodity prices, fragmentation, trade wars, tariffs. This is certainly a risk that is on the horizon. We're seeing also, as my colleague Tobias Adrian has mentioned, the fact that right now markets are still very buoyant. Valuations are fairly high. This is risk on. That could change. We had a taste of that in early August. That went away, but we have to be a little bit careful about change in financing conditions.
How interconnected are all of these things? And I'm talking on a country-by-country basis. As you know here, the globalization that brought us to where we are today has seen some fractures, some cracks here. And I'm wondering, is there any argument to be made that some of the concerns that you're raising now may be isolated to certain countries and regions?
Well, when we're looking at some of these risks that I've just outlined, and we've done a scenario analysis in our latest report published today, what we're saying is that really they affect almost all regions in the world. And so, if you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
We talked about central banks like the Fed tackling inflation without actually tipping the economy into recession. You've called this a major accomplishment, Pierre-Olivier, in part because it defies history, right? You don't expect that to be the outcome. What do you chalk it up to? What's different this time?
Well, we really looked in details into that episode, the surge in inflation and coming down in the report. And let's be honest, a good chunk of the disinflation is coming from the fact that the shocks themselves that led to the surge in inflation in the first place went away. Some of the tightness in supply chains and the bottlenecks and all of that went away. They were responsible for part of the increase in prices, and they're responsible for the fact as they eased that prices moderated. Some of the demand pressures also went away. Some of it's coming from central banks tightening. So there's certainly a role for monetary policy, but it's alongside also some of the shocks waning.
Okay. Now, when you go back to the financial stability report, the global financial stability report, it concluded that financial markets don't reflect all the global risks that we've just been discussing. So my question is, what do the financial markets reflect then? Because you could argue that they don't necessarily reflect monetary policy and the increased costs of funding either.
Yeah, we've seen many episodes in the past where there is a sense in which financial markets can sometimes be disconnected. And the question is, how do they reconnect? I mean, maybe they see something that, not everyone sees. And maybe some of the policy uncertainty will go away. Maybe some of the geopolitical risk will go away. And maybe we'll all land in the good place. But the worry is that, we might have the other scenario, which is that some of the repricing will come when somehow the markets price in some of these other risks. And that's something that we are, of course, concerned about. This is why it's important to have financial buffers. It's important to have fiscal buffers. It's important to be ready. And in our report, we outline how countries can improve their resilience in that front.
Pierre, I do have to ask you, though. I mean, we talk about coming into 2024, where we saw probably one of the widest spates of political and electoral activity that we've seen in more than a decade. A lot of those elections have been resolved, but of course the world's largest economy still awaits. 2 weeks from today, maybe we find out the winner. Do you have any sense of how the economic policies of either a new Kamala Harris presidency or a new Donald Trump presidency will affect your forecasts?
Well, I will not comment on specific outcomes of the election or what the programs might be, but there are a number of things that we can say about policies that would be good for the global economies and policies that could be harmful for the global economies. Again, if I go back to the analysis we did in our report, we find that an escalation in trade wars, regardless of where they're coming from, this is not just the US, by the way, there's been a lot of increase in trade policy, distorting measures by a number of countries in the last few years. There are upwards of 3,000 of them compared to only 1,000 back in 2019. And a further escalation in that space is something that would shave off, in our estimates, about 0.5% of world output by 2026. And the pain would be widely distributed. So these are clearly things that we hope not to see. There are other things that could be helpful. For instance, if we have more decisive policies to address some of the slowdown in China related to the property sector, that could be a boost to global growth. That could be something that is beneficial worldwide. We could see also some improvements in terms of productivity and innovation in the euro area. There's been a recent report on this that is generating some attention. That is an area where also faster growth in that space would be beneficial for the global economy.
All right, we really appreciate you taking time to be with us here on Consequential Report. As always, Pierre-Olivier Gourinchas, Chief Economist with the International Monetary Fund, as we continue to count you down to those closing bells with a focus up ahead on AI and Qualcomm. Its share is bucking the downtrend today on the heels of news regarding its Snapdragon Elite chip. A conversation with the CEO, Cristiano Amon, on deck in just a second.
Plus, GM topping the S&P 500 gainers list after a third quarter earnings report. Why one analyst says the results are eye-popping.
Eye-popping there. And of course, we may get some more interesting aspects out of Jana Eggers, the CEO over at Nara Logics. A closer look at AI and, more importantly, how it's infiltrating almost everything we buy and use today. That conversation and so much more coming up in a bit. This is The Close on Bloomberg.
Shares of Texas Instruments are lower as we await the release of its third quarter results after the market close. TI will give us the latest checkup on chips after last week's mixed messaging from ASML and Taiwan Semi. Analysts have penciled in that TI, which gets most of its profit from industrial and automotive chips, will report a 9% drop in revenue. Joining us now with a preview is Ryan Vlastelica of Bloomberg News. So Ryan, is AI a part of Texas Instruments' playbook at all?
It's not certainly a major part the way we see in some of the other chip makers that have really driven the sector higher this year, like NVIDIA, Taiwan Semi, so on and so forth. So it's kind of a good bellwether for sort of the rest of the sector, the part of the sector that has been sort of mired in a little bit of struggles, being seen weaker growth in some of their end markets. And the real question is, when are they going to start signaling a more robust return to growth in some of these key markets that they're in that haven't seen the kind of demand tailwinds that AI has?
I am curious, though, how much of a bellwether can we sort of look to Texas Instruments to be for that broader sector, whether it's industrials, whether it's electronics, whether it's automotives?
It's considered a pretty big bellwether for those types of things. So, maybe a little bit more last generation kind of company compared with the ones that are getting all the attention this year. But the fact that, they are still a major player in those categories, they're still, pretty closely watched stock, not one that's well liked among Wall Street analysts or investors, but certainly what they say is probably going to have some broader ramifications this afternoon and tomorrow.
And Ryan, there's a lot of concern here that Texas Instruments is really highly valued at this point. It's got a forward PE of 38 times, putting it leaps and bounds ahead of the rest of the chip sector.
Yeah, certainly it's a lot more expensive than its peers. The stock has done, okay this year. It's moving up. It's not quite as strong as the overall semiconductor index and certainly well behind some of the major AI stocks. But it does trade at sort of a hefty valuation. So given that they have sort of an uncertain growth outlook, the fact that the valuation is a little bit higher might just mean there's a little bit more room for error for them.
Is this still a relatively, though, volatile stock in the sense that does it trade a lot around these earnings reports?
Yeah, I feel like the past few reports have been greeted with some pretty big moves. They also had a capital spending update not too long ago, I think in August, that was greeted as pretty positive. So, yeah, it's not going to be like an NVIDIA type move where you see, double-digit swings or anything like that, maybe. But certainly it's one that people are going to be watching pretty closely, especially since we're still pretty early in the season for some of these chip names.
And very quickly, Ryan, what do we know about Elliott Capital Management and what is pressing for in terms of changes from TI?
Well, I know in the past they've been calling, a little bit more concerned about their spending levels. So anything they give, as far as their outlook for that, it's probably going to be closely watched by them.
All right, Ryan Vlastelica over at Bloomberg News. A closer look here at the potential earnings that we're going to get later tonight out of Texas Instruments, Scarlett. And this is kind of one of those weird ones, right? Because, it is still, I kind of feel, an analog company in a digital world, if you will. Yeah. But it's still very critical and still very important. In fact, I remember this conversation came up a couple of quarters ago, and I think I said something slightly disparaging about Texas Instruments. The analyst was like, no. Look, all these people have Jensen Huang and all those folks on speed dial, but they also got the CEO of Texas Instruments on speed dial. Yeah, their chips are just as important.
They have more than 100,000 customers, right? Their industries really run the gamut. So they're a really key barometer for the overall economy, if not necessarily the high-performing AI part.
And it runs into this whole idea, too, of sort of, older tech companies that were sort of at the vanguard of that first big wave of computerization and internet and everything else, and how they adapt to this new world that, at least for right now, seems to be moving to something a lot more automated and, dare I say, something a little bit more artificial. Our
producer was asking whether they still make calculators.
They do. In fact, I just had to buy one for my son a little bit, and I had to show him how to use it, in which me and my, CFA, you think I know how to do it. But
I thought you used the HP calculator.
Yeah, no, I was partial to the Texas Instruments one. The HP one, that's like, Paul Sweeney, old school, if you will, here. We do want to stay in the tech space, and specifically when it comes to semiconductors, and specifically when it comes to AI. Ed Ludlow, the co-host of Bloomberg Technology, joins us now.
Yeah, welcome to our Bloomberg Television and radio audiences around the world. We're joined by the Qualcomm CEO, Cristiano Amon, who's live in Maui from the Snapdragon Summit. And I think chief among what you're talking about is Snapdragon 8 Elite, right? And the technology shift is to the in-house design processor. But the question for you, Cristiano, is the same as it's been for quite a long time, which is what is fundamentally different through this processor in how we use our smartphone, the capabilities that an AI smartphone has?
Very good. Ed, hello from Maui. Good talking to you. We're incredibly excited with the announcements we made yesterday, and we have more announcements today. This is our 9th edition of the Snapdragon Summit. And what's more exciting about what we're doing with 8 Elite? is going to be the Snapdragon platform that does two things. With our new custom Orion CPU, it restores the leadership position in performance to the Android ecosystem. Smartphones powered by the A Elite are going to be the fastest smartphones in the world, period. But that's only half the story. The other part of the story, it is the platform that has incredible computing capabilities for AI. And we present a vision of the future, how the construct that we are used to in the smartphone of OSs and apps and app stores are going to fundamentally change as we have agents that are going to do a lot of the use cases for us. One of the most exciting things for Qualcomm of generative AI is that now computers can speak the language of humans. And that's where we are. There's a Snapdragon, there's a display, there's a human.
Right.
And that transition is about to happen. So we built the platform for that.
The forecasters, Cristiano, see the smartphone market growing, driven by Android. And what surprised me about this generation of processor is you get them into handsets quite quickly. Have you done the math on how you see that convert into market growth, how quickly the AI smartphone is a top-line driver for you?
Look, that's the multi-billion-dollar question. So I'm going to try to give you an answer, even though it's very hard to predict. I think it's very easy to see, and I have conviction in that. Within the next 5 years, we're probably going to have all of us with an AI smartphone. The problem is you have to wait for the new use cases to come up. It reminds me of the transition from feature phones to smartphones. When in the beginning, we talk about apps, we have 10 apps, then became hundreds of apps, then thousands of apps. And we started to see that happening right now. We have like 20 AI different use cases, and maybe that's going to become 100. So I think we are on a trajectory to get to that point. Maybe 5 years is where that transition will be concluded, and hopefully what we all expect to see is the smartphone market is going to grow, and we're going to see a new upgrade cycle.
When we talk about, though, the growth in that market, Cristiano, are we talking about new entrants into that space? And I'm talking on the customer side here, or is this simply converting the existing customer base that's already out there?
I think the typical answer that you're going to provide to this question is you probably expect existing players in the smartphone world to just build AI-capable smartphones. But it's really hard to predict. Every time we have a change in the industry, I think the mobile industry is one that every generation of wireless players did change. So that could happen too. I think what we're really excited about it is actually not really the players, but how the experience is going to change, how the devices are going to change, and that's going to require a lot of computing power for AI, and that's what Qualcomm's going to do. Qualcomm's really been positioning itself to be the company doing AI at the edge, and that's not only phones, it's PCs, it's cars, it's smart glasses, and I think that's the story of the company right now.
With regard to that story, and I'm almost asking this question on behalf of investors, and I would like you to answer it for investors. To a certain extent, this stock has been left behind with regards to the AI focus that this market has had all year long. Does these new chips and the new products that they will go into, will that change the narrative to the upside for investors on both the top and the bottom line?
Look, I have a slightly different opinion. If you look where the valuation of the company is right now, we're starting to get credit for the fact that we created new growth markets for Qualcomm beyond handsets. The stock had a lower multiple in the past because most of our revenue, and it's still a number one business, is mobile, and mobile was not growing. But what we have done is something different. We realized there are new end markets for our technology. And we built an automotive position. I think the Snapdragon digital chassis now is the key asset for the industry in automotive. We have a $45 billion contracted pipeline. 1/3 of that is ADAS and autonomy. We entered the PC space in the transition of PC to Microsoft Pilot Plus AIs, and we're going to start building industrial. So actually, we have been building new business for Qualcomm, and that has had a positive impact on our multiple. With that, this AI transition is about to happen from the data center to the edge, and we're just preparing ourselves for that.
In the smartphone context, what's happening in China is so interesting. Let's compare with Apple, right, in the iPhone 16. They're being rewarded in that market on Apple Intelligence features that aren't yet out in China and won't be for some time. So when you think about Snapdragon 8 Elite and your kind of first mover advantage, Do you feel you have a first mover advantage in China when it comes to the AI smartphone?
So let me talk about our smartphone business in China. We have been powering the premium devices of all the Chinese brands, companies like Honor, OnePlus, Oppo, Vivo, Xiaomi. And what we have seen, the China internet is a different ecosystem. All of those companies has been creating AI use cases. And what we see in China that we like, the market has stabilized it, but we see consumers moving up. So while the market doesn't grow as much, what is really growing is the premium tier. Consumers want to buy a better device. And what we have seen this year over year. So we're actually happy with our position in China. And, as we go into other markets, we're seeing our partnerships in China increasing. One of the examples, we're now partnering with every single Chinese EV company as well for automotive.
Cristiano, you're dedicating a day to those new chips in automotive. One of the questions from our audience is whether that's now becoming an isolated business, or if there's a kind of flywheel effect through the diversification efforts that you kind of were helming.
So thank you for the question. Right now on stage, we're announcing the most powerful processor we ever done in the history of our company, which is our new platform for automotive. We're announcing two chips, is Snapdragon Elite Cockpit and Snapdragon Elite Ride. And that is being designed for what we believe is going to happen with software-defined vehicles. Cars are going to get better over time. It is future-proofing the AI capabilities for Gen AI use cases when you're behind the wheel. Just as an example, is a 12x increase in performance versus the prior automotive chip that we have. It's an order of magnitude increase. And I think the way we look into this is we build a strong automotive business by being the digital platform of choice for all the car makers. Now we wanted to future-proof that platform for the future Gen AI use cases running on cars at the edge.
I've got to ask you the tough question here, Cristiano, and that's really about your ambitions to grow this company and expand it through acquisition. Of course, you've seen the media reports about your interest, your presumed interest in Intel. Do you have any intent on pursuing that deal anytime this year?
Lately, I'm getting this question all the time. Look, we don't comment on rumors, but let me tell you what we're actually busy doing. What we're busy doing is we have a unique opportunity for Qualcomm for the PC space. We saw the entry point driven by two transitions. One transition is mobile PC conversions. The other one is PC becoming an AI platform with the Microsoft launch of Copilot+. So what we did, we built the fastest processor platform, which is X Elite. And right now, it is still the fast performing processor. Both the incumbents in the PC, right, based on our announcement, created new products and accelerated the new products to compete with us, and that wasn't enough. So we see now an incredible opportunity for us in the PC, and especially as PC makers have questions about their future, they look at Qualcomm as a great player.
Cristiano, the interest on the whole Intel story was because you made progress on your own, ARM-based processors, Qualcomm processors, so why x86? Just give yourself a score out of 10 on how you did on AI PC so far.
Look, given the amount of skepticism that we got about people telling we will not succeed in PCs and would not be able to compete, I'll give us a very high grade. And the platform design traction is awesome. We launched 22 different laptops across all bands, Dell, HP, Lenovo, Asus, Acer, Samsung, and we continue to see design traction, especially as Microsoft prepares a transition for Windows to an AI. And one thing that we were tasked by Microsoft to do, and we did it, we restored the performance leadership of computing back to the Windows ecosystem. That's a great testimony of, I think, the Qualcomm engineering capability and our focus in growing this business.
There would certainly be a complement, though, to getting at least some part of Intel's business, whether it's the programmable chip division, which we already know that Intel has plans to try to spin off, and other aspects of that as well. Do you see a complement there at all?
Look, it's important to understand the Qualcomm strategy, and we have been very clear about that. Our strategy is pretty simple. We define our company, we have three assets: everything wireless connectivity, and we take pride in being the number one in cellular and Wi-Fi on everything wireless, high performance, low power compute, and artificial intelligence for the edge. And what we did, we applied those three technologies to all markets that are growing, and we could leverage our technology for phones. So we went from phones to cars to the PCs, and now industrial. And that has been part of our strategy. We did all organically with some of the small acquisitions. We feel we have a very competitive roadmap, and we're thinking about the new. What is the new innovation that is coming for those markets? And that's what we're driving. I will remain focused on that.
Cristiano, the Qualcomm of today is very different to the one that I first met 6 years ago. When I speak to investors and analysts, they do worry about kind of billions of dollars of lost revenue, particularly with key customer Apple and modem. But the question I get a lot for you is whether these kind of newer business lines, Snapdragon 8 Elite, the automotive side, make up for some of that lost legacy business going forward from 2025.
Look, I love answering this question because, that has been the story of Qualcomm of the past. Every investor saying, look, you have the best modems in the world. You have a very strong position with Apple, but, they're eventually going to do their own modem, going to lose this business. So we took a completely different approach. When I became CEO, I had an investor day in 2021, and we said that revenue is going to be removed from the model. And we are going to be creating new growth markets for Qualcomm, and we have a much bigger SAM opportunity than we have with mobile. We're just executing on this, and the results are showing. Look, $45 billion of contracted pipeline in automotive is not a small number. And you have seen in our earnings results, automotive has been record quarter over quarter because we're gaining share. That's the reason we are getting to the PC. That's the reason we're getting to industrial, because at the end of the day, it's not only about this one customer revenue, whether we have it or we don't have it. Yeah. It's actually, can we operate in growth markets and expand the company's SAM? And that's what we're doing.
And this is exactly what we've heard from investors, exactly what we've heard from analysts. They want to see that diversification. And just to be fair, Cristiano, they've given you a lot of pats on the back so far. There's still a long way to go. And I do want to circle, as we end this conversation, back to the automotive space, because we've been focusing a lot on that today on this show. And there are concerns here that we've sort of reached some sort of bump in the road with the adoption of new vehicles, whether it's EVs or autonomous vehicles, or really just vehicles that are much more sort of technologically inclined. Where do you fit into that space longer term? Is that going to be a bigger market? And more importantly, is it going to be a bigger market for Qualcomm?
Very good. So look, Romain, one of the unique things of our automotive business, we are kind of immune to that. Our position is not dependent on electrification or internal combustion. Our position is not really dependent of the shifts that you have in share across different companies. Because what we have done, we saw the cars are going to become digital computers on wheels. Car companies are going to become tech companies, and we built a platform for the car companies. And what happened is that had resonated well. So we're designed across all brands, all the Koreans, all the Japanese, the Europeans, the Americans, the Chinese. Every single car company now is using some portion of the Snapdragon Digital Cockpit. And what is happening with our results have been independent of the automotive market and more about gaining share. And as the new cars come out with our platforms, we're starting to see that go into revenue. We made a projection of $4 billion by 26, and then $9 billion by the end of the decade, and we're tracking that.
All right, Cristiano, we have to leave it there. We always appreciate your time. Of course, out there in Hawaii, the CEO of Qualcomm, Cristiano Amon, and our very special thanks to the co-host of Bloomberg Technology, Ed Ludlow. Now, it is just about 3:30 p.m. here in New York. The countdown to the close continues right here from Studio 2. Romain Bostick alongside Scarlett Fu on a somewhat tepid day in market. So we should point out it was red across the screen, I think, when we started the show. Actually seeing a little bit of buying activity as we get closer to the bells.
Yeah, but still very much, no one has a real clear sense of direction. We're at record highs pretty much for the S&P and the Dow. So, this is something where people are waiting for more clarity on the economics and certainly on earnings as the companies continue continue to report.
And we're going to get some earnings later tonight out of Texas Instruments. We were just talking with Cristiano kind of about the future of these chips designed for this sort of AI world that I think we're already in if we haven't already moved into it. And of course, that factors into your phones, your PCs, and as we saw at the end there, also your automobile.
Yeah, absolutely. And I liked his answer about how Qualcomm is equipped to, drive computers on wheels, the new generation of cars, whether they're powered by gas, diesel, or electricity. All right, well, with GM reporting earnings this morning and Tesla's results due out tomorrow, electric vehicles clearly at the front of investors' minds. According to Cox Automotive, new vehicle sales volumes likely fell 2.1% in the third quarter. That's versus a year earlier. But EV sales rose 8% in the same period. I want to welcome now Jon McNeill. He's a senior former executive at Tesla and Lyft and current co-founder and CEO of DVX Ventures. Jon is also a board member at GM and Lululemon. Welcome, Jon.
Nice to see you both.
So EVs are selling better than any other car segment in the U.S., but there's this persistent narrative that EVs are underperforming. We know the big automakers have really pulled back on their production and on spending. What's gone wrong? Where did the industry go wrong in this narrative?
I think what's happening is you see EV sales increasing much faster than the market. And so there's a narrative that's being told largely by oil interests during a political campaign to downplay what's happening in the EV space. But EVs are growing quite dramatically. And I think there were projections that they would grow even faster. So that's some of what you hear. But right now, GM, for instance, is selling more EVs than they have before by an order of magnitude, and will sell more than 200,000 this year.
Yeah, EVs are definitely growing at General Motors, but they're still losing money. So it becomes a matter of economics, and this is where we come in with reports of these car makers having to pull back. And it's not just GM either. We're seeing the same thing from European automakers. What is the balance that they need to get here?
I think when you have a portfolio that includes gas cars and electric cars, you can balance those portfolios. And we saw today that GM beat on the top and bottom line quite substantially. And part of what's driving that is profitability in EVs. GM promised the market that they would get to profitability on a gross margin basis on EVs this year and into an EBIT basis next year, and they're executing on that. And that really helps the bottom line when you can start to make money on EVs.
I do want to talk about how AI fits into all this, or whatever we're referring to as AI these days, and specifically focus in on Tesla. They had that big day where they unveiled their general concepts, let's just call it, for a robo-taxi, a robo-van, and of course those AI, humanoid type robots. Whether you buy into exactly the technology that Musk says he has, a lot of people looked at that presentation and they said, oh yeah, I can see this as our future. Is that our future?
I think the future's here. A few weeks ago, I was in San Francisco. On a Monday night, I spent 2 hours in robotaxis.
Wow.
And it's a stunning experience.
Are these like the Waymo ones? Or
Waymo, and I've spent time in the cruise robotaxis as well. They're handling the most complex environments, like the San Francisco streets and the LA streets. And Cruise is now live in Houston and Phoenix in addition. And so the future is here. Waymo's doing 120,000 paid rides a week right now. So that's substantial. And but you have seen major advancements in AI. It started as a machine learning and robotics program, and has shifted really quickly to a platform that's based on large language models.
I mean, the whole idea of automated driving, I think, is intriguing for a lot of folks, particularly folks like myself who hate to drive. But there's also this idea of how smart can those cars be and to react to things? I mean, I don't know if you've ever driven around a New York City street, but
I have.
It ain't San Francisco. I know San Francisco has its own challenges, but people you hear today just walk right out in front of you. They don't care. And I wonder, can we trust that technology? Or are people, laymen, not necessarily the tech experts like yourself, are they going to have that faith and that trust that when they get into an automated vehicle, that they're going to get there alive?
That's right.
Forgive the phrasing.
And they're already proving now they're way safer in terms of accidents and injuries, way safer by a large margin than human drivers. As you mentioned, like one of the motivating factors around this is that around 40,000 people die annually in traffic fatalities. And 95% of those roughly are human error caused. So if we can get rid of those, that's a huge step forward for humanity. That's 40,000 families that don't experience a loss. And so the current technology is way safer, and it's becoming even more and more human-like, as I discovered a few weeks ago.
Does it matter, the auto manufacturer? Because when I hear about this technology, it seems like we're just talking effectively about a lot of the chips and the guts that go into the vehicle. Does it matter if it's a Tesla or a GM or, some other brand?
I think it does. I think this is a very difficult hardware problem, but it's an even more difficult software problem.
Gotcha.
And so the OS that runs the car is going to become essential here.
Is it a software problem when a Waymo self-driving car has a woman trapped inside and there's men standing in front of her asking for her number and it won't move and she can't get out either because there's actually no driver? I know this was a video that went viral earlier this month and it was in San Francisco, but this is something that kind of raises people's concerns about why these vehicles are not, they might be safe in terms of you won't die in a car accident, but people don't necessarily feel safe in them.
I felt really safe in the sense that I wasn't having to wonder about a driver and that driver's background, et cetera. But as you say, there are software problems, hardware problems, and that was an operational problem, it sounds like to me. And so it's been sort of treated as a bug, not a feature, to have humans intervene and help to move that car. And I think you're going to see more and more of the bug becoming the feature, which is there are human beings that can step in and intervene and move that car in an edge case situation like that.
Tesla gets the lion's share of attention. We talked about the robotaxi event that was long on hype and short on details. And of course, this is for good and for bad. Is Tesla's first mover advantage completely neutralized now?
Well, I think there are roughly 5 levels of autonomy, not roughly, there are. Tesla is at definition L2, level 2. Waymo and Cruise are already at L4. So Tesla is they're playing a catch-up game. They have not had a lead in this space, and they haven't been in number one. That's been Waymo and Cruise thus far.
Is there a sense, though, as we sort of go deeper into this future, and I know that you're still investing in this space.
Yes.
I think when a lot of, at least public investors, public market investors, when they look at, say, how you play the AI thing, it's basically Tesla, NVIDIA, and maybe a couple of companies in between here. What is the universe of companies that are in this space that are investable at this stage, not just in the public markets, but also in the private?
I think one of the underappreciated areas of AI investment is in the infrastructure space.
Okay.
When you put an AI infrastructure together, that includes data centers, obviously. There's cooling, racking, heating systems, et cetera, energy systems behind those. And there's a whole supply chain that is fueling the AI revolution. And I think investing into that is a very ripe space for investors. And you see Blackstone and others who are stepping on in with large infrastructure funds around AI that go beyond just the end chip makers.
All right, Jon, always a great conversation, always illuminating. Appreciate you stopping by. Jon McNeill there, he's the CEO over at DVX Ventures. A conversation there, of course, about electric vehicles and automated driving. And we want to stay on this story here and focus a little bit closer in on General Motors. It's time now for our top calls, where we call up one of the big analysts of the day to talk about one of the big stories of the day, and that is General Motors shares having their best day since 2020. The automaker readily beating profit and revenue expectations, raising the low end of its earning forecast for the full year. Joining us now for more on this is Wesley Brooks. He's over at HSBC Securities. And Wesley, there was a lot to like in this report, certainly in the short term. Longer term, are you also encouraged?
Hi, thanks. Yes, great to be here with you. We are. I think today's results, basically a pretty strong beat, really coming down to pricing. So this whole year, I think the market's been expecting pricing to soften, as have we, and really GM's just been outperforming on pricing. They've been executing, they've been keeping their incentives significantly lower than the market while still gaining share. As we look, sorry.
Well, give me a sense as to why, because when I look at their lineup and their pricing for that matter, it's not a whole lot different than maybe what we saw with some of the efforts by Ford and Stellantis, so that's a whole different story. But what are they doing that's unique that gives them that pricing power and, more importantly, I guess, that contribution to the bottom line?
I think it comes down to a few things, and Ford's actually doing a good job as well. But I think part of it is just having fresh models. So they've had significant new model refreshes. They have a new mid-sized SUVs. They have new full-size SUVs coming. I think the other part is, as we've come out of the pandemic and the supply disruptions with the chip shortage, these companies have kind of learned to operate with just more disciplined, right? So they're being a lot more disciplined on how much they produce. If you look at where we stand now, the industry as a whole is producing around, or is selling around 10% fewer new vehicles than prior to the pandemic. And so I think that comes with this discipline and focusing more on value over volume.
Okay. So let me just follow up, Wesley. When it comes to how it can sustain this kind of sales growth, does it have the pricing power to kind of keep pushing ahead, or is it going to have to start offering more attractive incentives?
I mean, incentives have been going up through the year, and I think we should expect that. I would say that, if we look to the next year's guidance, we're probably going to see something similar to what we started off this year, which was the company started off saying probably prices will be down 1% to 2%. I think it's reasonable to assume that there could be some pricing pressure next year, particularly just if we look at the macro. It's kind of finely balanced for the next 6 to 9 months, with the economy slowing but not going into a recession. And then after that, we get some benefit of probably lower interest rates, loosening up consumers' wallets. So, during this period, affordability is an issue. Car prices have gone up significantly. The average payment on a new car is up over a quarter over the last few years. So it's reasonable to say that there could be some pricing pressure, but we don't think it's going to collapse.
What about China? I mean, it's seen this steep sales decline there. Is this something that GM can solve on its own, or does this require bigger changes in U.S. policy?
I think China is less about U.S. policy and more just about how it's positioned in the market. The Chinese market has rapidly shifted to EVs, and GM is in a different position there. So we're less optimistic on China. I mean, are they going to be able to make some money? I think so, but I think for GM, we have to think of this as a GM North America business. This is by far the biggest driver of their earnings.
Fair enough. Wesley Brooks over at HSBC, thank you so much. That was our top call of the day. And of course, anytime we talk about cars and paying for cars, you have to bring up auto loans. And there's an interesting story in the Bloomberg about how, as much as we talk about inflation slowing down and getting closer to that 2% level, the actual CPI basket doesn't take into account a lot of costs that you and I pay up for every day. And that includes auto loans, that includes credit card loans, and that includes student debt. I mean, none of that is factored in. So even as the official numbers show things are getting better, we don't feel it.
Well, it's interesting, and I understand why they separate it out. I mean, from the geeky economist perspective, I mean, it's technically not spending, but of course, for practical purposes,
it's coming out of your wallet.
Right, and at the end of the day, it offsets what you would spend on something else. But it gets to this idea, too, because I remember Jay Powell was asked about this in one of the meetings. It was like maybe earlier this year. Specifically, this question about this idea of how much are you factoring in these burdens on the household that maybe aren't showing up specifically in those inflationary numbers. And he seemed pretty cognizant of it. Of course, in typical Jay Powell fashion, he didn't actually answer the question, but he did kind of make it clear that, I'm aware, and thanks for that question. I'll take it into consideration.
Absolutely.
But it's a meaningful thing. And I mean, you don't need to be an economist to understand this.
No, when you go to a restaurant and you tip, I mean, that's 20% of the bill on top of that, but that doesn't get factored into CPI or anything like that. And we've been tipping a lot more since the pandemic.
Have you been tipping a lot more?
I have been. I mean, I'm reminded to every time I try to buy something. It often encourages me to pay 30% tip. So there you go.
Tip jars are like everywhere now. Or the tip screens. Do you actually do that? I just try to pretend like I didn't see it.
Yeah, I know.
And then they give me that evil eye.
And we'll see how good of an actor you are. Coming up, we're going to take you to the close with Heather Brilliant, CEO at Diamond Hill. This is The Close on Bloomberg.
there's a lot of resilience in the global economy, and it's a lot of resilience despite the fact that inflation has been coming down, despite the fact that central banks have tightened interest rates tremendously over the last 2 years. So that's kind of the good news. Inflation is now close to target. The battle against inflation is almost won. There are maybe some residual risks out there in terms of inflation path, but really this is good news.
And some of that resiliency he was speaking about, you're seeing that in the markets today. Pierre-Olivier Gourinchas, the chief economist with the IMF, he kicked us off to the close just about 50 minutes ago here, and now seeing some modest bids come back into this market. But we should point out, it seems that the enthusiasm for this rally that we had seen just over the last couple of weeks, at least for right now, that seems to have waned.
It's stalling, right? Yeah. We're at unchanged right now. We were looking at the first 2-day decline in about 6 weeks, which gives you a sense of...
Which everyone keeps telling me is important, but I was like, 6 weeks?
Well, it just goes to show we've been grinding higher slowly, even though it feels like nothing's happening.
Yeah,
maybe
I looked
that's
back
part
at
of
that,
it.
and then somebody was like, oh, well, if you look at it in the context of what happened in 1933, and I was like, what are you talking about? I don't know.
Well,
anyway.
I mean, a big part of it is that big tech isn't necessarily consistently participating in the rally, right?
But that was supposed to be the good thing, right? And we knew this was going to happen, that once the bigger weighted names sort of, not necessarily fell out of favor, but that ebbed a little bit and people rotated into the less weighted names, that meant that that market on aggregate wasn't going to see the same performance.
Well, industrials was supposed to be part of where they rotated to, and today they're down about 1%. You've got GE, Packer, LMT, Lockheed Martin, all down, so that's a big weight there. And of course, the chip index not doing too well.
You saw some of the earnings out of their names. There's a big part of the reason for that as well, too.
I know.
Maybe that turns around a little bit later in the week with Texas Instruments and Tesla and some of the more techie companies. Maybe that provides some more optimism.
Yeah, well, we'll see. It all depends on the forecast and how much you're willing to say.
Absolutely. Here, a closer look at the short term as we move closer to those closing bells. Just about 8 minutes to go. And joining us here in studio is Heather Brilliant, CEO over at Diamond Hill, joining us in studio too. Great to have you here.
Thanks for having me.
I do want to circle back to the top of the show. We focused a lot with Pierre-Olivier about kind of the long-term growth forecast. Now, as you know, the IMF did ratchet down their forecast ever so slightly. But it was kind of tinged with this idea of optimism, the idea that we're coming down to more of a base level for economic growth worldwide. And I do wonder if we might see something similar play out in capital markets, where some of those really outsized gains that we've gotten used to over the last decade or so, that maybe that just needs to come down a few percentage points.
Yeah, I mean, I think whenever you're looking at what you're expecting from any equity, you're really looking at a component that's coming from multiple expansion, potentially, and a component that's coming from earnings growth. And so to the extent that we are seeing strength in earnings, I think that has really been supporting the market. The question really is, how far can multiple expansion go? And it feels to me that we've really pushed that about as far as we can go. And especially seeing the market kind of broaden out in the third quarter, I think you're really seeing more and more companies at pretty meaningful valuations.
And that seems to be a big part of the reason why we've heard so many people call this year kind of a stock picker's market. It is kind of a bottom up, look for the individual names and find value. You do that.
We do that.
Where are you finding the value?
Well, first of all, I'd say, too, on individual names, it seems like the discrepancy between companies beating earnings, doing extraordinarily well, double digits well, and companies that miss their earnings doing terribly, double digits poorly, is really stark in this particular earnings season and really over the course of this year. So I think you're seeing that come through a lot. But in this environment, I think one of the things we really like to look for are high quality businesses that we think are trading at a reasonable price or reasonable valuation. And so Cisco is one of the ones I would mention. Cisco, the food distributor.
Cisco, okay.
Yes,
All right.
SYY. And that's a company that I think is an incredible business. It is a great distribution business that has a competitive advantage because they have access to so many different items of distribution that go into the whole food value chain, and they have relationships with all of the food retailers or restaurants, et cetera, hospitals, things like that. And I think those relationships and their ability to just have higher volumes because they have such meaningful market share gives them a tremendous competitive position. And when you can find a business like that trading at a discount to what it's been valued at for most of the last 5 years, I think that those look like great opportunities to us.
You also like some financials, including the insurance company AIG. Walk us through what the timeline is here for AIG and why you like it.
I think AIG is a little bit more of a turnaround story. If you're taking a multi-year perspective, they brought in a management team that we think has been doing all the right things to turn around the business and really focus on how they can make sure that their core business is really focused on P&C, which is their strength and where we've seen a lot of the market strength in insurance. And they're selling off their whole life and wealth business, which is a much lower quality business for them. And I think that concentration on P&C isn't really being valued appropriately by the market yet.
Okay, so that's a bottoms-up approach. I'm wondering if you see value in looking at things from a sector perspective. For instance, utilities, which have been one of the best performers this year and certainly of the second half on that tangential AI story that everyone needs power to, to run their data centers. Is this a good time to consider going into it and holding for a longer term?
That's something we have looked into, but have not been totally convinced that the valuations support the benefits that utilities will see as part of that value chain. So I think
it's a good story.
It is a good story, but the valuation really has to support the story. I would say we see a little bit more of a story in insurance. If you wanted to, broaden out AIG to more of a theme, where we're seeing improving pricing in P&C, and so you're seeing other companies in P&C as well, like Aon, doing better. And they're in insurance brokerage, which I think is also a part of the market that can continue to benefit as insurance is such a critical part and essentially required for so many areas of the economy.
We've gotten this far in the interview. You haven't mentioned AI or tech, really. Is that just not on your focus, or do you find something in there, or is it maybe just a little bit too frothy, if you will?
I mean, it's definitely, I don't think anyone can avoid looking at AI and thinking about it and making investment decisions. I think ultimately we're really looking at valuation as a key driver of our investment decisions. And so, even if you look at a company like NVIDIA, while the valuation is very rich, the earnings power is also very strong. And so I can understand why a lot of investors have found that to be a good place to hide in this market or a place to be in this market. That's just not, for us, a valuation that we can consider, sufficiently putting the risk reward in our favor.
Any concerns about the election? And by that, I mean that the outcome would change your investment plans or thesis in any way?
I don't think so. I mean, that's one of the benefits of being very bottom-up oriented. We don't feel like we have to, suddenly pivot our strategy if we, have a different outlook on who's going to be in the White House or in Congress, et cetera. So
that must be nice to not have to ever talk about that. Meanwhile, on this program every day. All right, Heather, always a wonderful conversation. Always great to have you here in studio. Heather Brilliant is the CEO over at Diamond Hill, joining us to count down to those closing bells, which are now just about 2.5 minutes away, Scarlett.
I'm looking at the volume, and volume is about 5% below the 20-day average. Every day it feels like we're just kind of making our way to the close.
Yeah.
And you mentioned the election, of course, in 2 weeks we'll actually, be holding the polls. And it might be a week, it might be a month before we actually get the results.
And it's kind of interesting. We ask these questions of all of our guests, and a lot of them have basically said, look, I'm relatively sanguine about what's going on. There are certain industries that could be majorly affected by this, but broadly, it could be more of the same. We continue to count you down to the closing bells. Stick with us. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through the closing bell, a global simulcast. It starts right now. Tim Stenovic in the radio booth, joined today by Emily Grafale. Carol Masser has the day off as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, on a day, Tim Stenovic, where I was told we were getting our first back-to-back decline on the S&P in 6 weeks. What's happening?
There's still a minute left.
Okay.
That could happen.
Did I jinx it?
Oh, hey, we're actually seeing stocks, the S&P 500. Oh, never mind. I was going to say it. Moving a little.
We're on the knife edge here.
You got to be fast.
Yeah,
Tim.
not really. The S&P 500.
Yeah.
I guess
Emily
we can go ahead and pretty much
think about
call that
this?
unchanged, guys.
Do you let her talk?
It's still green. It's not, I mean, I guess we could call it unchanged, but not a lot of, there we go, not a lot of action after the S&P 500's
I love this
best
minute-by-minute, second-by-second update.
Win streak.
It's like a
not a lot of action in the bond market today either, given the big moves that we saw yesterday, right? The 10-year yield got to 4.21%, and there was talk that maybe we've gotten to the point where rising bond yields are starting to threaten stocks. That was the storyline yesterday. Maybe not so much today.
Yeah, and I love that too, because it gets to this idea that whatever narrative that you're crafting in your head today is probably going to have to be changed within the next 2 days. And this has really been the seesaw that we've seen now, right, for the last few weeks now.
Look at this, guys. 22.7%. is what the S&P 500 has done so far this year. The fact that we've gone 6 weeks without back-to-back declines says something about the rally.
Yeah,
That's a grind higher.
I think the thing I love about that most, Tim, is that you included the 0.7%. You could have just rounded up to 23%.
Not yet.
All right.
End of the year. End of the year, I'll do it.
All right, EQT ringing the bell over there. And who is that? Oh, look at that. Cohen and Steers also ringing the bell there at the NYSE. The Dow Jones Industrial Average in the red on the day as we wait for these numbers to settle. But it looks like it's going to basically be unchanged on the day. We were just talking about those back-to-back declines on the S&P. It looks like as these numbers settle, we are going to be in the red, down about 3 points or roughly less than 0.1% here on the day. The NASDAQ composite higher on the day by 0.2%, as is the NASDAQ 100, while the Russell 2000 closes out the day lower by 0.4%.
All right, taking a deeper look at the S&P 500, pulling back the layers there as things get settled. 316 stocks did move lower in the S&P 500. 186 did move higher today.
You know, we may, after all, get that first 2-day losing streak in 6 weeks, Romaine. It's just for you.
I love it.
All right, let's take a look at the sector performances. I didn't even print up the hat, Scarlett,
I know.
For this. Well, you know, don't print it up just yet. The consumer staples were the best performing group. That was led by Philip Morris. That group up 0.9%. Communication services and energy also finishing higher, but not by a whole lot. Industrials were your weak link with names like General Electric, Lockheed Martin, and PACCAR all down at least 4% on earnings. Materials also losing ground along with utilities.
All right, let's get to some of the gainers here. I want to start with General Motors. Shares surging today, having the best day in more than 4 years, up close to 10%. How's that for rounding up, Romaine?
I like it.
The company reported that they're just making a lot of money with gas SUVs and pickups, offsetting some other weakness. I know you got earnings that you got your eye on. Romaine.
Yeah, before we go any further, let's just get to Texas Instruments crossing the wire right now. The company is saying that third quarter revenue coming in at about $4.15 billion, and we're being precise because the street was looking for $4.12 billion. So a slight beat on third quarter revenue, a slight beat on third quarter EPS at $1.47. The street was looking for $1.37. Your forecast going forward, fourth quarter revenue, $3.7 to $4 billion. The top end of that range is below the average of street estimates. They were looking for 4.1, and their forecast for fourth quarter EPS, guys, 107 to 129. That's the range. The top end of that range below the average of street estimates. The street, guys, was looking for $1.35.
And when you look into the business itself, let's just look at the analog revenue, $3.22 billion, beating the consensus estimate of $3.17 billion. Third quarter operating profit, $1.55 billion, also topping the average analyst estimate of $1.46 billion. Notable that the stock is down about 2%. There was a lot of talk, a lot of ink spilled about this idea that valuations were really lofty for this name, certainly higher than a lot of its peers, given that AI is not the bulk of its business. The bulk of its business is in the industrial market, the auto market.
Yeah, and that stock is down about 2%, even despite the fact that the third quarter results were pretty good. Third quarter EPS beating estimates at $1.47. Third quarter analog revenue also beating estimates. And their operating profit for the third quarter coming in at $3.22 billion, which was also a beat.
I'm not getting a lot of commentary from Haviv Alan, the president and CEO of the company, in the press release. We're going to have to wait for the call a little later. But did note that the past 12 months, they invested $3.7 billion in R&D and SG&A and $4.8 billion in CapEx, returning $5.2 billion to shareholders. Shares in the after hours down about 2%. All right, let's get back to some of the gainers as we await Enphase Energy results in just a few minutes. As I was saying, GM shares having their best day in 4 years. The company signaled solid demand for its highest margin vehicles, even as the broader market softened. Better than expected results for the latest quarter. They raised the low end of its full year profit. The SUVs and pickups that people are buying, the old-fashioned gas vehicles, offsetting weakness in China, EVs, and then in that Cruise autonomous driving division as well. Let's talk Philip Morris International, the maker of Marlboros. It turns out Zyn is so hot right now. The company forecasts higher than expected profit this year, soaring demand for Zyn nicotine pouches in the U.S. Biggest one-day gain going all the way back to 2008. Shares higher today by 10.5%. The company said adjusted diluted earnings per share will grow as much as 15% for the full year, excluding currency movements. That's up from previously 13%. And finally, in watching ADRs of SAP, shares rising to a record. Revenue soared over at the software company. It's transitioning customers away from locally run systems with the promise of AI tools and analytics. Higher today by a little more than 1%.
What are you looking at there? What's on the ceiling there? Is there another phone in the ceiling?
I'm looking.
That's where the gainers are.
Yeah, that's where the gainers are.
They're
up
there.
Like the monitors here.
So Emily will be looking down at the floor.
Yes, exactly. Okay, well, I'm looking at 3 of the worst performing stocks in the S&P 500 today. Lockheed Martin shares fell 6.6%, the biggest intraday drop since March 2022 after its third quarter revenue missed expectations, pulled down by weaker aeronautical sales and ongoing issues with
Let me
its
just
F-3
jump in,
fighter
Emily,
program.
because we've got Enphase Energy share earnings coming out. This is the manufacturer of solar energy equipment. Fourth quarter revenue forecast missing analyst estimates, and this is the outlook of here. It sees fourth quarter revenue of $360 million to $400 million. Analysts were looking on average for $437 million, so that's a pretty big miss on that front. When it comes to fourth quarter adjusted gross margin, the company sees 49 to 52%. Analysts were looking for 47.8%. The stock is bouncing around a bit here as we report third quarter revenue of $380 million compared with a consensus estimate of $392.5 million.
Okay, let's get back to those decliners. Just finishing up on Lockheed, one of the other issues, bringing shares.
Sorry, I'm just going to interrupt you again, Jared, just for 1 second,
Nice
Emily. We're actually getting some preliminary results out of Starbucks. Those shares plunging in after hours trading right now. The company saying their preliminary fourth quarter comp sales down 7%. The street was looking for a drop of 3.5% here. So basically coming in worse than expected by a magnitude of 1/1. Fourth quarter net revenue, the company saying that will come in at roughly about $9.1 billion. Also saying that adjusted EPS will come in at 80 cents a share. The street was looking for $1.03. So a big miss here on comp sales, a big miss here on EPS and the bottom line. Not quite sure what the comparison is right now on the revenue side. Oh, there's your revenue guidance here. So 9.1 billion. The street was looking for 9.36. So Tim, a miss on the 3 key metrics.
Look, this is a company that has, the challenges have been well documented. This is why they brought in Brian Nickel from Chipotle. They were supposed to report earnings next Wednesday, on October 30th. So coming out with these numbers, the company does say it reflects a challenged customer experience. Management is developing a plan to get back to Starbucks. They'll provide insights into its plan during the fourth quarter and full fiscal year 2024 earnings call. Shares moving lower in the after hours.
And they cited both softness in North America's revenue and then also said that the preliminary fourth quarter China comp sales are down 14%, which was worse than estimates. So really, I guess, a global slowdown.
And I do wonder, Scarlett, whether this is we're getting into that sort of kitchen sink trend where a new CEO takes over. They look at all the bad things and say, let's just get this out there now, get it out of the way so they can focus on the future. Of course, one of the other headlines, Scarlett, of course, is that they're actually suspending their full year guidance for 2025, which I guess shouldn't be too much of a surprise.
Yeah, I mean, it speaks to the idea that Brian Nickel wants to start with a clean slate here, right? He's going to set the terms for everything. And we should mention also that they are boosting their quarterly cash dividend to 61 cents. That's pretty much what analysts were anticipating, but he wants to kind of start fresh. He did make a comment saying that I've spent my first several weeks in Starbucks really listening to feedback from partners, engaging with the customers. Again, that idea that perhaps not that he gets a pass, but he's not being judged here so much as the previous CEO because he's taking over and going to set a new path forward.
Look, he's got his work cut out for him.
Yeah.
And I think the term clean slate is a good way to think about it. By getting ahead of these results, he just took the helm earlier this month, so he's got the work.
But I mean, look at the hole that he's digging here, or maybe not he digging. I should say the Starbucks has dug here. Fourth quarter China comp sales down 14%, way worse than expected. U.S. comp sales down 6% here. So we're talking about the most important market, the U.S., and a market that, of course, they've really flailed in China, that they were trying to get some traction on. At least in the short term, it's not there.
Well, remember, his experience is really stabilizing U.S. businesses. I don't know that he did a whole lot with overseas businesses, but he has to tackle the biggest part of the market first for Starbucks, which is North America.
All right, guys, 6%. We're going to continue this coverage of the breaking news, not just from Starbucks, but earnings numbers as well. We got other big earnings coming up a little later this week. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, Bloomberg Originals. We'll see you guys tomorrow, same time, same place.
All right, stick with us. A lot more coverage of all those earnings crossing the wire, including the deeper dive into Texas Instruments. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
I'm Romaine Bostic here. The markets are closed and the markets are down. The S&P 500 back-to-back declines for the first time in 6 weeks. The Dow, the Russell, and the S&P 400 mid-caps also moving lower. Modest gains on the NASDAQ here on the day. And despite some of a lot of the volatility we saw in the yield space, not a whole lot of movement on the directionality, Scarlett, of those yields. One of the biggest decliners, though, at least when it comes to the stock space here. You saw that in home builders for a second straight day.
Yeah, down 2.6% in cash trading. Let's move on to what's happening in after-hours trading, because Texas Instruments, which makes analog chips that has more than 100,000 customers, came out with results, and it gave a downbeat forecast in a sign that demand is still fairly sluggish after an oversupply of these chips. So sales in the period will be $3.7 to $4 billion when analysts were looking for almost $4.1 billion. That stock lower by 1% in after-hours trade. Starbucks down 4% in after-hours trading as well. And this was a surprise because it was not scheduled to report earnings. And here it's saying that comparable sales in the U.S. and in China missed analyst estimates, and it is suspending its full-year outlook, which really speaks to this idea that it doesn't have clarity on anything yet as it moves forward with the turnaround plan under Brian Niccol.
Absolutely. Here, we're going to talk a little bit more about that, but just some quick breaking news. This on McDonald's. The share's down 8% now in after-hours trade. The CDC saying an E. coli outbreak affecting 49 people in 10 states that they have now linked to a strain that they're now linking to McDonald's restaurants. They said that McDonald's has removed the suspected ingredients temporarily, and they are investigating. We're reaching out to the CDC and to McDonald's, but the share is reacting heavily to this right now. Meanwhile, we turn back to Texas Instruments, a modest move in the shares here in the after-hour trade following their most recent earnings report. Brian Colello is technology equity strategist over at Morningstar, and he joins us right now. All right, Brian, let's just get right to it here. I mean, when you looked at this report, I know there's a tinge of, disappointment from investors, at least based on the knee-jerk reaction. But did you find anything positive in this report?
Well, I think the earnings in Q3 were just fine, that they did hit guidance, that there wasn't a deterioration in the past couple of months. The guidance for Q4 is weak, although there are some seasonal factors that always make Q4 a little bit worse for TI. Again, it's worse than what was expected. But this isn't like the train wreck sort of quarter that would suggest that automotive demand has fallen off a cliff or industrial just isn't recovering whatsoever. And in the meantime, TI always manages these cycles quite well. They're highly profitable, great management team, so they'll be just fine in the long run.
Yeah, they've been through this about 20 times over and probably more than that, Brian. I did take a look at that CapEx spend. It is still healthy. It is still rising. Were you pleased with that, or do you think they should have given us more?
Oh, I think they're going to keep spending according to their plans for this year, next year as well. I think it's the 2026 CapEx that might be variable. It is the key consideration for investors in the long term, how aggressively they spend if they start overbuilding. But again, it's a very good management team and that we think will navigate through cycles and demand. But on the whole, it's aggressive if you think about sort of the next 2 to 3 years of spending. But when you get to 10 years out, which is what the management team's thinking about, they'll be just fine.
So when Elliott looks at these results, and Elliott, of course, took a $2.5 billion position in the company last year, or I should say earlier this year, what is its criticism going to be?
Yeah, that's a good question. I think the criticism is really more about a couple of years from now. We're in a down cycle, and it was pretty dreadful. There was a huge inventory correction, and I don't think Elliott or anybody else should be expecting a quick turnaround in 2024 because of that inventory overhang. I think more of their concerns, rightfully so, was we're in a down cycle. They seem to be expanding aggressively. Free cash flow is low. What's it going to look like? And TI had a call a couple months ago, and they're calling for a big snapback in free cash flow. I think $8 to $12 per share in 2026. So I think as long as they get towards that metric, I tend to think that investors should be just fine. But it was important for TI to come out with that sort of forward-looking guidance.
So put this all together, Brian, because over the past week, we've had this backdrop in which you saw strength in AI and cloud versus everyone else based on ASML's results and TSMC's results as well. How do Texas Instruments' latest results add to that narrative?
Exactly, and they are separate, and that's sort of the conversation we've been having with investors, that ASML's shortfall in sales is probably very much an Intel issue, a Samsung issue, and maybe China issue. Taiwan Semi doing well because there's still just tremendous demand for NVIDIA's chips. You have the Apple rollout. So those two businesses are really on the cutting edge of chip manufacturing, and you see a different story depending on who the buyers are in those cases. TI is a bit of their own. They're outside of that. What's leading edge for Texas Instruments is lagging for the other companies and sort of a non-issue at ASML or Taiwan Semi. So Texas Instruments is really about that long tail of 100,000 customers that you talked about, and selling 40 cent, 50 cent, $1 parts to a broad range of customers. That's just not what Taiwan Semi or ASML do.
All right, and Brian, a final question here, and this gets to this idea here of the longer term aspect of what Texas Instruments looks like in a world that is becoming much more digital. I understand their chips are still essential, and a lot of what they make is still essential. Do you see any potential of an evolution beyond that? And more importantly, do you see an evolution that will involve M&A?
Good question. So I think TI basically goes into every electronics device or analog chips or microcontrollers. And even if you think about these NVIDIA GPUs and their server racks, you see content on those boards, whether it's from TI or some of their peers that are around it. And so TI is more of a safer way to play the rise in electronics content. You have more chips per car, more chips per industrial device, and if you have more and more data centers and more NVIDIA GPUs and servers being sold, that's good for companies like Texas Instruments as well. On the M&A front, I think there is opportunity. If they're going to build out all this capacity, I don't think there's a lot of terrific targets for TI out there right now. They haven't made a big deal in about, it might be 15 years. But it's possible that they're loading up for a big one, and they're going to have the capacity to fill those fabs and to bring those orders in. So I think that's possible.
All right, good stuff. Brian Colello, technology equity strategist at Morningstar Research Services. Thank you so much.
All right, and just a couple of big movers in after-hours trade, both in the food industry. McDonald's shares down 8%. Scarlett, after the CDC cited an E. coli outbreak that they've linked to quarter pounders at McDonald's locations in at least 10 states. The CDC saying more than 40 people have been affected by this and at least one death. Starbucks also lower as well. They were supposed to report earnings next week, but they're out early.
Yeah, and of course, Brian Niccol did say he'll be able to give more details about his outlook at the earnings conference call, so we have about a week for everyone to speculate what that might look like.
McDonald's and Starbucks, two of the biggest decliners in after-hours trade, as is Enphase Energy, which just came out with their results. In fact, that is the biggest decliner in after-hours, at least amongst the larger cap names here. A miss on several key metrics for that company. The shares down 9%.
Yeah, this is a maker of solar energy equipment. Of course, it's been very sensitive to those interest rate increases because people buy their solar panels on not layaway, but they have to borrow money to do it.
Yeah.
All right, coming up, our next guest says the bull market may continue its grind higher. Anthony Saglimbene, he is chief market strategist at Ameriprise Financial. He'll be joining us next. This is The Close on Bloomberg. All right, JP Morgan and Goldman Sachs are at odds when it comes to the long-term outlook for U.S. equity returns. Our next guest says that as long as fundamental conditions remain firm, the bull market should continue to ride the near-term ups and downs in sentiment while continuing its grind higher. Anthony Saglimbene, he is chief market strategist at Ameriprise Financial, joins us now to discuss. So, Anthony, does that mean that valuations are not too stretched right now?
I think valuations are stretched based on this year's earnings, but valuations are probably more fair based on next year's earnings. So a lot of optimism has been built into share prices. Sure. Absolutely. But if we get that soft landing, economy remains firm, corporate profits growing into next year, interest rates are coming down, then I do think stocks can grind higher. And it could be from areas that have not kept pace with the rally, like financials and cyclicals outside of technology.
Okay, and does this have anything to do with people positioning for, one White House outcome or another?
Yeah. So if you look at the prediction markets, they're certainly favoring a Trump victory and maybe even Republican control. But I would say, there's international investors in there. There's, there's mostly supporters of Trump. So I would discount some of the prediction markets, and I would look at very tight polls. So we're likely to have at the top of a ticket a very tight, close election, and we're likely to have divided government. And if that's the case, then I think once we get through the election, markets will start looking through that election and onto what I think are still solid fundamentals for the economy.
And this is always a good reminder for those folks who are brave enough to try to position around this election. I feel like all the election outcomes, for the market at least, that we predicted in 2016 and then later in 2020, you would have been wrong. A lot of folks would have been wrong, on the wrong side of the trade, I should say.
I would say, look at financials that are doing very well. We just got a batch of bank earnings that have been very good. Capital market optimism is high. Consumers are in good position. You have strong lending and credit activity. That is really the health of the economy right there from a corporate profit standpoint. We have big tech earnings next week. They're likely to be solid. And so a lot of the market's momentum is based on strong fundamentals and growing corporate profitability. And some of the areas that are starting to perform better, like small caps, they benefit from a growing economy. And I think those are the factors that play more influence on the stock market than the election.
I am curious, though. You mentioned big tech, and we've all seen the valuations on some of those names. Even if they have a solid quarter, to use your phrase, is that going to be enough?
Yeah, I think it'll be enough if you look out over the next 5 quarters. Big tech, the Magnificent Seven, are expected to grow their profits by double digits over the next 5 quarters. So a lot of optimism about those profits are built into valuations. But if they achieve them, I think that will be a positive for their share prices. The AI secular theme continues to play out. We'll see what some of these companies say about generating revenue from that. I think for companies like Alphabet and Microsoft, it'll be positive. I think the outlooks will remain positive. And if we get that kind of environment over the next week or two, then I think the outlook for big tech remains positive.
How are you thinking about the macro backdrop? We seem more confused than ever as to how many times the Federal Reserve will cut interest rates the rest of this year and next year. Given the data that's coming in, it continues to surprise to the upside. Yeah,
the market's gotten it wrong all year. And so when you look at what the market has been saying about rate cuts for the next 6 to 12 months, they've been largely wrong and they've had to readjust. What has been right is what the Fed has communicated in terms of their outlook, the statements from Powell. They have said we're going to take a data-dependent approach. We're going to be contingent around inflation moving lower. We're a little bit more geared in towards the employment market right now. So our view is that they'll likely cut in November by 25 basis points, again in December by 25 basis points. If they do that, that should reduce some of the anxiety that investors have felt about will they or won't they and by how much. I think that's the key for investors.
I want to look a little bit long term, like really far long term, because there's been a lot of talk about a lot of changes, structural changes in our economy, in our capital markets, and how folks should maybe reshift their portfolios around that. There's been talk there'll be less money coming into public markets, more into private markets, and to a certain extent, more into fixed income, as some people are predicting that yields, to a certain extent, will actually manage to keep pace with, I guess, prospective stock market gains.
Yeah, so we put together our strategic asset allocations every year. We review our capital market assumptions, which are built on that 10 and 30-year time frame. And over the last couple of years, we've reduced the returns for equities because of some of these frictions on inflation, global trade, more geopolitical frictions, and less stabilization in world economies, and a little bit of a pull forward of a lot of the returns that we've seen over the last couple years. And so our view is that over the next 10 years, you could see lower equity returns. However, they're still favorable. And as an investor, you need a diversified portfolio of equities, bonds, and alternatives. And we wouldn't be shying away from equities just because the returns might be a little bit smaller.
Anthony, what do you think about the $6.5 trillion that's sitting in money market funds that could be put to work, but so far hasn't, and is still holding near that record high? I mean, have people kind of, come to terms with the idea that it's going to be sticky and it's going to stay there because people like the returns that they get on Treasury bills, even if it's eroding over time?
Yeah, what we've been advising our Ameriprise advisors and clients is to start looking at that money market, those short duration assets, and start having a plan to extend duration and lock in some of these higher yields. So I think there's plenty of ammunition on the sidelines to start looking at fixed income and longer duration fixed income to lock in these higher rates. We know the Fed's lowering interest rates, so take some of that excess cash that's earmarked for investment and start getting some higher yields that you can get over time. That money going into the stock market, I'm not sure about. A lot of money moved from savings and deposit accounts into money markets to capture those higher yields. That money might be a little bit sticky and there for a little while.
All right, Anthony, always a great conversation, and even better to have you here. And I'm really glad that you brought the nice warm weather from Michigan. I don't know what it's like in Michigan today, but here in New York, it's absolutely beautiful.
Yeah,
great to see you, man. Anthony Saglimbene, Chief Market Strategist over at Ameriprise Financial, as the close continues to march on with our focus today on AI as we inch closer to those earnings out of the Magnificent Seven. We heard from Texas Instruments earlier today. We're going to hear from a true Mag 7 tomorrow with Tesla reporting, and that's followed next week by Alphabet, Meta, Microsoft, Amazon, and Apple joining the party at some point in the future. Jana Eggers is the CEO of the AI company Nara Logics, and quite frankly, one of the pioneers in this space, and pleased to say that she joins us now here in Studio 2. Great to see you, Jana.
It's really good to see you all.
I want to start off. We were speaking a little earlier with the CEO of Qualcomm, who unveiled a new a chip designed for this sort of AI world. And he sort of envisions this broad world, kind of like years ago when we were talking about the Internet of Everything or whatever the phrase was. He kind of says that that's kind of where we are going with AI. It's going to be in our phones, our PCs, our cars, and probably a bunch of other stuff that we don't want. Is that moment already here, or is that still very far out into the future?
I think it's both.
Okay.
So some of it is already here. Some of it's already here.
Yeah.
It's in everything.
Yeah.
It is. But it's very narrow. It's doing really specific things. And I think what you're going to see, and we talked about it a few times ago when I was here, how Apple is starting to integrate it across your mail and your calendar. And so you're going to see those tentacles start to spread.
As those tentacles spread, though, as you know, we're an investor show, and everyone is looking for where that investment opportunity is. It's been a relatively narrow opportunity, at least in the minds of a lot of investors. They gravitate to a Tesla or NVIDIA, maybe a Microsoft. I know there's a lot going on behind the scenes in private markets, and you have obviously a front row seat to that. Is there a lot there?
There's a lot.
Yeah,
there really is. And I think you're going to see more companies less focusing on that, the ground floor, if you will, of the LLMs, and more, how do we make that technology along with other optimization technology, along with automation technology, really work together to build a better solution. And you're going to have a lot of opportunities there. And some are going to come from older, more established companies that start learning how to use this better, although they don't move really fast.
Well, they have to get past a lot of layers, right? And they also have to spend a lot, and those returns might not come immediately. So how do you balance that as a legacy tech company when you see how quickly investors will punish you for not showing the returns on your spending on AI chips, for instance?
Yeah, I think that's a great question. I think, they have the advantage that they can do smaller tests and really see what's going to work. I think one place we aren't good at as technology as a whole is system of systems. So they're not as good at doing that integrated piece. They're more used to being focused on one thing. So how do they learn all of those different technologies and then figure out how to bring them together? And I think that's your point about they're not going to get the returns quite as fast.
Yeah. Or they buy someone else who does it. And that's another question, because then you've got culture clash, you've got systems clash, you've got operations clash, not to mention regulators looking over your shoulder.
I've been bought a lot. I've done 7 startups and I've been acquired several times. And it is always a challenge, to your point. There are culture clashes, and
the integration's hard.
The integration's hard from the culture perspective, from the technology perspectives. There's often, very advanced technologies from the small companies and laggard technologies from the big companies. Those don't go together that easily. It's getting better, though. I will tell you that. That is getting easier overall for technology.
But on that investment side, and I want to bring it back to public markets for a section. We started off talking about the Mag 7. There's been a lot of talk about the mamas Is that how you pronounce it?
Yes.
And this idea of, and forgive me, I'm going to get this wrong. This is where I was showing my ignorance.
I like Mama better than Fang, though.
Mama, yeah, it's a little more palatable.
What's the acronym?
But agentic AI, am I pronouncing that correctly? Yeah. So who are the companies involved in this? And to kind of explain what that actually means to a layperson. So, not to your like nerdy friends, but like the people who don't understand.
Of course, agentic AI is just like, I have a friend that's doing it for me, right? I mean, so it's an agent that's actually going out and acting on your behalf.
Okay.
Whether that's making a restaurant reservation or going out and finding the best gift for something, that agent is working on your behalf.
Okay.
And so I wouldn't necessarily look at all of the mamas as players there. They're definitely going to be making some of the enabling technologies. I think you're going to see somebody like Microsoft, obviously.
So Microsoft is one of the
going much further, right?
What's the other M? It's Microsoft, and you got 3 A's in there. So I know Apple.
Meta, of course.
I
know.
Why not?
See, we don't think Meta. We think app, right?
I
know. So, and then you've got Alphabet, Amazon, and
Apple, right?
And Apple.
Yeah, okay.
How can we forget Apple?
What about Salesforce? Shouldn't it be there too, given that it does the whole AI agent thing as well?
Yeah, probably, but they haven't really been doing the foundational technology, and I think that's they've been using other technology more.
I see.
And they did buy a few companies early on, but they haven't done that in a while.
Okay, so when you take a step back and you look at, Romain gave us the laundry list of all the companies that will be reporting over the next 2 weeks. What do you look for in their earnings reports that tell you how far along they are in their journey to incorporate AI into their businesses and to make that a key offering to their customers?
So on the earnings side, I'm looking at investment. So I'm looking at where they are in R&D and how that compares in announcements that they make. Looking at Amazon, when they made the announcement about how much they were saving with AI, I look at, well, how much are they investing? And it was a really tiny proportion of their R&D investment that they were actually saving with AI. And that I'm looking for more and more, like to see, okay, they're saying they're getting this back, but what are they actually investing in? How do they balance those things? And that's me, the tech nerd.
No, and that's why we want to ask you, because you're looking at it a completely different way than someone who's looking at it as an investor.
By the way, this is a tech nerd-friendly show, so just so you know.
Thank you.
Yeah.
Jana, always a pleasure to have you on. Jana Eggers is the CEO of Nara Logics and our go-to person for all things AI.
All right, we do want to get back to that breaking news in the food space. Breaking news on both McDonald's and Starbucks, 2 big movers in after-hours trade. On McDonald's, the CDC here in the U.S. issuing a safety alert about an E. coli outbreak linked to McDonald's Quarter Pounder burgers. And then Starbucks suspending guidance for fiscal 2025 while reporting preliminary same-store sales that fell 7% in the most recent quarter. Carmen Reinicke joining us right now here at Bloomberg News to talk a little bit more about this. And I want to start with Starbucks, because this is the more intriguing story to me. We had Brian Niccol come in, and we know he's only been on the job for all of about 2 hours. There's a sense here that when new CEOs come in, they look at all the bad things and just kind of kitchen sink it, just throw everything out there for investors, so it's not going to be a distraction in the next quarter or the quarter after that. Is that what this is, or is there something more serious going on that we should be paying attention to?
I really think that is what we're seeing here. I mean, so Starbucks was already scheduled to report their quarterly earnings next week. I think they still will be holding a call on October 30th. And as you said, Brian Niccol just started. This will be his first earnings report as CEO. Obviously, he wasn't responsible for the quarter that they're going to be reporting, but it is going to be a first chance for investors to hear from him, to really maybe hear about his plan for Starbucks going forward. And you're right, I think there is this sense of sort of getting some of this stuff out of the way to kind of clear the path for a new strategy. I think suspending the fiscal guidance is something that investors are reacting to right now. I mean, that's always important. We want to know. And then, of course,
he wants his own guidance, right?
Exactly, So I'm assuming that that's something that in the future we'll be hearing more from on Starbucks.
Clean slate, and so people don't come in with pre-existing prejudices like, oh, well, he tends to be conservative or he tends to be aggressive with his forecasts. Starbucks has a lot of issues it needs to address, or Brian Niccol needs to address. What's the most important right now? Obviously, North American sales, but what within North American sales? He talked about this overly complex menu.
Yeah, I mean, I think that that's something that's really important. We've seen that, baristas are frustrated. I think consumers have had different complaints about how Starbucks has changed over time over the the last few CEOs maybe. And so Brian Niccol really is being tasked with fixing the image here, getting it back to a place perhaps where people are sitting and working in the cafes again, things like that. I think it's important to note that he, is someone that's had successful turnarounds in the past. Yep. His tenure at Chipotle was very, I think, lauded. I mean, the investors really loved it. The shares, were consistently hitting all-time highs and, doing very well in the restaurant space. So that's what they're looking for from Brian Niccol at Starbucks.
I do want to turn to McDonald's right now. The shares have been plunging here in after-hours trade, at one point down more than 10%, which if this carries over into the cash session, going to be one of the biggest drops we've seen on this company in years. And this is all related to a CDC alert about an E. coli outbreak. What do we know? Yeah, this is significant. So what we know right now is that there is a food safety alert about an E. coli outbreak in Mountain West states. And it's linked to the chain's Quarter Pounders. So right now we know that there are 27 people that have been sick in Colorado. One older person in that state has died, and 49 people total from 10 states are ill. The CDC says McDonald's will remove the suspect ingredients. And one thing I think is important to note here is that we don't know exactly which ingredient right now might be causing the outbreak. Quarter Pounders obviously have beef that's usually cooked, so it could be something else. Just important to note. But those things will be unavailable in those states for some time.
All right, good stuff. Carmen Reinicke, thank you so much for giving us the overview on what's going on with not just Starbucks, but McDonald's as well, both stocks plunging in after-hours trading. We want to switch gears to consumer trends because Rakuten, which is the cash-back shopping platform, has published a new study that shows, well, a disconnect between retail marketers and shoppers before the 2024 holiday season gets underway. Retailers are confident that they will meet their holiday sales targets. Meanwhile, 45% of shoppers are planning to spend less on holiday gifts this year. Joining us now in studio to discuss is Julie Van Ullen. She is the Chief Revenue Officer of Rakuten Rewards. How does something like this get resolved? I mean, do retail companies just finally realize that they have no choice but start cutting prices in order to get, the customers in?
I don't think it's that, and I think it is quite complicated, and it's complicated every year because it changes every year. I do think that before I answer your question, it'd be remiss just to not kind of remind folks about Rakuten and where this study came from. Rakuten is the largest cashback shopping app out there with about 17 million shoppers and 5,000 stores on our site. So when we do talk about a study like this, which we did in conjunction with Harris Poll, it really is quite massive, and it really spans across a great deal of categories as well. And I think one of the most interesting findings, honestly, is that consumers, 81% of them, intend to spend the same or less than they did last year, right? And they explicitly told us that because of that, they intend to prioritize value over brand loyalty. And then asking the retailers the same exact question, 20% of them simply don't believe that that's true, right?
Well, can I just stop there? Because I thought that was very intriguing, because there seems to be a huge disconnect. We talk a lot about the markets, how, the Fed believes one thing and the markets believe another thing. You have retailers that really think this is going to be strong, or at least that seems to be where they're putting their money is. And yet you're telling us you did this survey and all the consumers are basically, look, we're tapped out, we're going to buy early, and we're not going to care about brands. And this gets back to Scarlett's question about how do you resolve all that? Or does it not?
I think that that's exactly right. I mean, your point about timing is a really important one as well, because in this study, the other huge discrepancy that we found is that their number one concern is that consumers believe that inflation will increase post-election. This is their number one concern. Number two concern is that they know this is a condensed holiday. They've been hearing in the news things about port strikes. They're worried that they'll get their goods on time. So between concerns on delivery and concerns on inflation, they are out there early. They are out there shopping. So key is retailers need to listen. Retailers need to pull up those promotions. They need to start meeting the consumers where they are.
Okay, so how quickly do they need to do that, and in what way? How did they do that thoughtfully rather than in a last-minute rush kind of way where it kind of screams of desperation?
Yeah, I mean, through a variety of tactics, right? It's not just promotions. It's not just price. Rakuten exists as a huge partner to these retailers because we're able to offer them an incentive that provides almost like a permission to buy for the consumer, if you will. So it's really about getting creative around when are your big promotional moments, when are moments that you really want to shore up the shoppers who have shopped with you before using tactics like cash back.
Yeah.
But fundamentally, if the vast majority of retailers right now have this high degree of confidence that they can just spend all of their advertising dollars and promotions in the back half of November and early December, they're simply going to lose out to the ones who know otherwise.
In this survey, did you get a sense of where they're going to spend their money, with which retailers? I mean, are they going to go into the malls and the physical stores, or is this going to be another, Amazon e-commerce type of story for the holiday season?
They're shopping across all categories in e-commerce for sure, but in-store will be a massive increase this year. Rakuten
in-store?
I believe so. Rakuten itself, we have our own in-store capacity where people link cards such that they can get cash back when they go shop in-store. And
so they link their credit card to that?
Exactly.
And so if they're in the store and they swipe that card, then in theory they get the reward on that.
Same reward, exactly.
Yeah.
And that part of our business has increased 44% year over year. Also tie that with a concern around delivery timing. People are absolutely going to be going.
Well, just a dumb question then, just real quickly. Are you anticipating a boost in your business because of this? If everyone's so cost conscious, I think they would gravitate to things that in theory save them money or they feel like they're getting money back.
100%.
Yeah. Okay.
We always see an increase in shopping in election years in general because there's turbulence. And this year there's turbulence and uncertainty in a number of facets. So absolutely. And we serve as a partner to these retailers. To your point, they don't have to, there's no desperation. There's no even margin concerns when they can use a mechanism like cashback to not give away so much of their margins.
So the loss in loyalty that consumers are talking about, is that a permanent thing or is that just for now while times are tough?
I would predict it's just for now while times are tough. Younger shoppers are a bit more fickle than others, I would say. So certainly we need to make sure that brands are thinking about who their next new loyalists will be. I think categories like luxury in particular are ones that need to be thinking about who are their next shopper going to be and how are they going to attract that shopper.
All right, great conversation. Julie Van Ullen, the Chief Revenue Officer over at Rakuten Rewards. A closer look at the health of the consumer heading into this holiday season. When we return, we're going to take a closer look at the state of organized labor and a look back at the 1981 air traffic controllers strike that backfired, breaking the back of unions and ushering in 4 decades of employer rule. That conversation coming up next here on The Close on Bloomberg.
We're going back to the 80s, huh?
All the way back to 81. All right, let's take a look back at this day in history and the workers' strike that effectively killed the Professional Air Traffic Controllers Organization and really hobbled organized labor across U.S. industries for decades to come. It really all started to unfold when the traffic controllers and the Federal Aviation Administration began contract negotiations earlier that year, centered around higher pay, fewer work hours, and better retirement benefits. Now, the FAA did concede on pay increases, but wouldn't budge on a shorter work week. So on August 3rd, 1981, the union known as PATCO declared a strike. Now, unlike other strikes, this one was unique in that federal government employees, which includes air controllers, were legally prohibited from walking off the job. That didn't stop them. And it drew the immediate ire of President Ronald Reagan, who called the strike a peril to national safety and ordered all 13,000 union members back to work. Only 10% complied, leading a federal judge to find union leaders in contempt of court and pushing the Reagan administration to fire more than 11,000 controllers, and also prompting the Federal Labor Relations Authority on this day, October 22nd, 1981, to order the union dissolved.
We cannot compare labor management relations in the private sector with government. Government cannot close down the assembly line. It has to provide without interruption the protective services which are government's reason for being. But I must tell those who fail to report for duty this morning, they are in violation of the law, and if they do not report for work within 48 hours, they have forfeited their jobs and will be terminated.
And that really was the shot heard round the union world. It was the first federal union to ever be decertified, but not the last. The PATCO strike was a soul-crushing defeat that would hasten the demise of organized labor influence. Corporations saw what happened with PATCO, they watched what Ronald Reagan did, and they were emboldened to stand up as well. An Arizona copper mine strike in '83 dragged on for 3 years before most of the unions involved were decertified. Hormel in '86 broke the back of its striking workers with scabs, as did International Paper in '87, and on and on and on. Historian Joseph McCartan said that prior to PATCO, the idea of firing striking workers was almost unthinkable, even though it was legal. The ramifications, they were immediate. Prior to 1981, there were more than 300 major strikes or lockouts each year. By 1982, that number had dropped to less than 100. By 1990, less than 50. In 1991, U.S. Representative William Ford of Michigan said that after PATCO, the wholesale replacement of strikers had become epidemic. And Ron Taylor, who in 2001 served as president of the Reformed Air Traffic Organization, called PATCO's failure an American labor tragedy. Indeed, look no further than 2023, a summer of strikes that contributed to the most active year for labor disputes in more than 2 decades. Yet, the number of major labor actions that year totaled just 33, less than a tenth of the number we saw prior to PATCO in 1981.
And that is why we give you a bit of history for that context, because it did feel like it was a summer of strikes, even though historically it certainly was far from it. As far as 2024, this election is critical for the labor movement, at least according to our next guest, Kate Bronfenbrenner. She's senior lecturer and director of labor education research at Cornell University, and Kate joins us now. Kate, Biden calls himself the most pro-union president out there, and we know President Trump has been gaining support from union households as well. What is the divide right now in terms of what the Republicans and what the Democrats offer to unions?
There's no question that Trump and the Republicans have had a very anti-union policy. We can see it when Trump was president. We see it in the fight to dismantle the NLRB, to get rid of the power of regulatory agencies to enforce regulations like health and safety to protect workers in the workforce, and that, even during the campaign, Trump has, hired non-union workers to show up and rally with him at the time when the UAW was on strike, rather than supporting striking UAW workers. It's important to remember that there actually were, more than 450,000 workers went on strike this year. The reason the numbers sound so much dramatically less than they were in 1981 is that Reagan changed the way strikes are counted. So only counted after 1981, only counted strikes that had more than 1,000 workers. But we had many strikes across the country in small units and big units, and we've seen more workers striking in the last several years than we've seen in decades.
Have we seen, though, any sort of residual effect from that, Kate, in terms of union membership increases? Because there has been a lot of talk about some of the numbers of union membership and how they didn't budge a whole lot coming out of 2023.
For union membership to grow, they have to organize millions of workers each year because of the number of union jobs that are lost or the contracting out of union work. And what we saw in the last year is that unions actually, in the private sector, union membership grew. It was only, less than 1%, but it grew. But in the public sector, there's been so much cutback in public sector employment, which is almost universally unionized, that really hurt. So that, yes, union percentages have declined, but unions make a noise much larger than their numbers, both politically and in the economy. And we can see, more workers are organizing now than have organized in years. And we see the public support for unions is the highest it's been in decades. Most interestingly, among young people is where it's exceptionally high, more than 80%. And that really says something about the future.
You made the case that there's a clear distinction between the two parties on labor issues, yet you look at the rank and file members of unions and their loyalties are split. Why is that, Kate?
Well, they're not split 50-50. You see that their majority of unions have endorsed the Harris-Walz ticket. Yes, there's one big union that is not endorsed at all, with the Teamsters that stayed out of it. But the big difference is that the membership is divided more like 60-40 in some unions. And that's because they are frustrated. They're frustrated and angry about decades-long wage stagnation and huge corporate profits, and they feel like the Democrats haven't done enough, the Republicans haven't done enough, and they are angry.
But Kate, that's not a new thing. I mean, when I was looking at that PATCO strike, I mean, PATCO endorsed Ronald Reagan heading into that 1980 election, and then, of course, they learned a hard lesson about not doing that in the future, but apparently other unions haven't learned that lesson.
The unions have to learn that lesson over and over again. You talked about the 90s where there was one kind of broken union after another, but by the end of the 90s, we saw a wave of major victories in Pittston Coal and NYNEX and Ravenswood Aluminum, and that's because unions learned that they had to take on employers, globally. So, but then they forgot, and they have to learn the lessons all over.
All right, Kate, we have to leave it there. We're up against a commercial break here. Appreciate you taking time for us. Kate Bronfenbrenner, a senior lecturer over at Cornell University and a former labor organizer herself, as we wrap up our program here on The Close. We'll be back tomorrow, but stick around. The team at Balance of Power is coming up next for all your political coverage right here on Bloomberg.